We're going to take a look at the American perspective, as you know and cover very, very well. And when we look at the state of the American market and the growth, we saw some good manufacturing figures this week. How important is that trend, that it keeps going? Because we've seen a bit of uncertainty and volatility in the last year.
Sure. Well, I think things right now in the U.S. are getting better. They've been gradually improving. It's been a story I know we talked about last year when we did our look ahead at 2013. I said at the time that this would likely be another year where the U.S. economy feels like it's getting rich slowly, and that sort of steady growth is continuing. We're not only seeing that, though, in the U.S., but globally, and how the global economy does also impacts how the U.S. does. And so we are seeing improvements. That's likely to continue.
Now, when we look at production figures for America, over 8 million barrels a day, and we've also got huge inventories right now. How is that impacting just the balance, particularly at home on the domestic market?
Well, what we're seeing are basis differentials where some of the crudes in the U.S. and the mid-continent, those grades are trading at a significant discount to Brent. That's one of the reasons WTI has fallen off, really as a global benchmark, or some of those supply situations. That's why Brent is now maybe the preferred thing to look at. But in general, we do have more supply coming online. That's going to continue as well. But the global economy is going to be really important for what happens to those barrels as well as the barrels everywhere else.
Federal Reserve tapering is pretty much in place. Is the oil market looking at it as a done deal, and has it already been priced in, do you think?
This stimulus is, I can't emphasize enough how important this is to keeping that U.S. growth going, which is both a positive and a negative. It's positive because we've been getting growth, but it's negative because at some point the stimulus has to end. And that's one of the reasons I continue to see U.S. growth as being modest, because when they pull this back, they're spending so much money. To give you some idea, if the U.S. economy adds, they're basically, the Fed is spending $3 for every dollar of growth you're going to get in GDP this year. It's a huge amount.
How will this impact the oil market when that eventually does happen?
Well, I think if they do it right, you should still get U.S. GDP next year around 2.5%. This year, GDP growth in the U.S. we're forecasting at 1.7. So next year, a little better than this year. We heard that in the comments, the opening statements here today. Next year's growth getting a little bit better in the global economy, and that's true in the U.S., but not a lot better because you're pulling back on some of those stimulus.
When we look ahead to 2014, what are going to be the big issues that the ministers and oil producers really have to be examining very clearly?
Well, I think on the demand side, it's this growth story. You have accommodative policies everywhere in place. Almost every central bank, except maybe Brazil, has been cutting their rates or keeping their rates low. And by doing that, that's creating a positive growth environment. So we've already heard that. They're looking at growth next year better than this year, which means oil demand growth, especially better next year than this year. Same thing in 15. So they're looking at a positive trend in demand. Seems logical, makes sense, pretty easy to see that train coming down the track. On the supply side, there are a few different things. You continue to see Iraqi production go up. There are questions of whether the sanctions on Iran will be lifted. If that happens, you have a lot of oil that can very quickly come back to the global market. And then you have continued increases in U.S. North American oil production, which was also mentioned earlier today.